Investing for beginners, lesson 4, price buying principles. This is a very important section because for beginners, it can be very difficult to understand how trading stocks actually works and what methods to follow when going forward with buying shares of a company. So now that you know how to find a good company and at a good price, let's get into the details of figuring out how many shares to purchase. First, we will cover understanding how trades actually work. Then we will discover what the correct/least amount of shares you need to buy in order to be successful. Next, we will go over the idea of what am I actually risking, because most beginners are intimidated with the idea of spending so much money on one stock or investment. And lastly, we will cover how to set goals for your stock investments. So now we're going to talk about understanding trades. And when you make a trade, which is essentially a transaction with a brokerage firm, it costs an average of $10. Now that price can vary depending on the firms, and they might also have promotions where it doesn't cost any money, but the average is between $5 to $10. So for this example, we'll use about a $10 cost for a transaction. And this can be a very important factor because if you don't buy enough shares, it won't be enough to cover that transaction fee. So, as an example, let's take a look here. Say that you buy one share, because a lot of beginners say, I want to be conservative, I just found a share at about $35, I'll buy that one share. But it's actually going to take you a really long time to make your money back. So, if you look at this, say that you buy one share at $35. It actually costs you $10 to commit that transaction. So your total cost overall is $45. Say the stock now goes up $1. You think that you've made money because, hey, look, the stock went up. But it's only at $36, and the total that you make is actually what your initial investment was, $45, minus the price of the stock, which comes out to $9. So you're actually still down $9 after the stock goes up. So the stock will have to go up $10 in order for you to just break even. And that is very difficult because it takes a long time typically for a stock to go up $10 at a time. So instead, look at a much bigger example where you buy 100 of those shares. So yes, it costs you $3,500, which seems like a lot of money and can be a lot of money, but if you buy that many shares, it only costs you $10 for that many shares. It doesn't cost you any more money. So then your total cost is only $3,510. Now when the stock goes up $1 to $36, you're right off the bat, you're up $90 because of your total cost minus the value of the current value of the stock plus your shares. So as you can see, this is a much better situation to be in because it only has to go up $1 for you to make money. Now if it goes down $1, you also obviously lose that money right away, but it can easily fluctuate back and forth, so you can't worry about those intermittent drops right in the beginning. And that's what we're going to go over next, is understanding why buying so many shares at one price isn't necessarily the best thing to do, but instead buying a few at one price and then a few at another price. So let's head to that slide now. So as I just mentioned on the previous slide about how it's important to buy the right amount of shares so that you don't buy it all at once, then it goes down $1 and you're very frustrated. Because as a beginner, that's can be one of the hardest things. You save up all this money, you wait every day to figure out exactly, okay, the price, I think it can't go any lower, it's not going to go any lower. You buy all your shares on that day, you're very excited that day. All of a sudden the next day or the minute you buy it, the price goes down even more and you feel like you missed an opportunity. But an important thing to remember is that you can't have that mindset, because typically it's naive to think that the minute that you buy shares that the stock is only going to ever go up from that day forward. So what you have to do is put together some type of approach and figure out the total number of shares that you want to buy, and then maybe only buy a certain percentage of those at a time. So say that you buy 100 shares. You should probably only purchase 25% of that total at a time. That way it's in chunks of 25 shares, 25 shares, and then another 25, and then another 25. It all depends on how the market is starting to react to the different purchases, because if you do buy the first 25 and then the next 25, but you really see it making an uproar, you might want to put in the 50 at that time. But at least doing this conservatively really helps you figure out what's a good price to buy it at, and then you're not as unhappy when the stock goes down. So as an example, say you first buy 25 shares at a price that you're fairly happy with, but could have the potential to still go up or down. Then if the stock drops a little, buy 25 more shares at a better price. Because essentially the goal of this action or this style is to finish with buying the 100 shares at a low dollar cost average. So say you buy some shares at $25, but then it goes up to $28. So then you buy more because you think it's only going to go up. At least you still have another 50 shares on the side, so that if it goes back down to 25 or even down to 23, you can buy more, and then your average will come right back up to around the $25 that you wanted to pay initially. So it's a very good style. Now, with all of this said, the one thing that you have to remember is that you should really only do this strategy if you've been tracking the price for a very long time and it's a very stable company. You know that it's really just an economic fluctuation and the company isn't just bleeding money and losing money and they're just dropping and tanking because they're doing so bad. So that's something to keep in mind. Especially you got to be careful with very new upcoming businesses that are just on the market that are a little bit cheaper for that reason, and you don't know whether they're ever going to go back up or not. So that's why you have to be careful, is to do it more with well-established companies that you're comfortable with, especially as a beginner, and then you can, go forward with those other stocks maybe down the line. Now let's go over, what are you actually risking? Typically, an initial investment for a beginner in a stock can be around $1,000 to $3,000. Now that may sound scary, but if you are conservative, you shouldn't ever lose even 1/3 of that. Most newcomers to the stock market always get very scared when I say stuff like, I just bought $5,000 worth of X number of shares for a company. And they wonder, how are you willing to risk that much money? But in reality, if you're investing in a very conservative company and their stock price is not too volatile, then you shouldn't lose too much money, because you should always sell if it really is tanking. Because the only time you're ever going to lose all of the investment is if the company ever goes bankrupt. So, with that said, let's look at an example. Say you purchase 25 shares at $50 a share, which is $1,250. Now, that's a decent amount of shares, and it's not too much of an investment. It's something that a beginner should have enough money to really consider putting into the stock market. The stock drops $2. That's really not that big of a deal, because you only lost $50. Which is nowhere near the total value of how much you invested. It's only a 4% change in the price. So this is why you shouldn't be as nervous, because yes, you invested $1,250, but if the stock drops $2 or $3 or even $4, you're only down 8%, and you know that you can easily get that back as the stock begins to climb. Because typically your investments are long-term investments between 1 to 5 years. So you know that there's plenty of time to recoup any of those small short-term losses. So the final point here is if you start off with a conservative amount of shares, then the fluctuations won't worry you as much. So in conclusion of this video, we're going to talk about setting goals, because you have to be realistic about how fast and far a stock will grow. The stock market is not necessarily designed for fast, quick, and large profits. Now obviously, if you have a ton of money and you buy 3,000 shares and then it goes up $3, now you have almost $10,000 in profit. But as a beginner, you want to buy a conservative amount of shares and then steadily grow to a specific price goal. And then once it makes that goal, potentially just sell and be happy with those profits because you're still learning. So a good goal to set is about a $10 price rise, because it's can be ambitious because it can take a long time for a stock to get that high, but it can also be great to accomplish. And as an example, you purchase 100 shares at $25, which equals a $2,500 initial investment. But if the stock goes up $10 to $35, now your investment is valued at $3,500, and that is a 40% gain. And there's nowhere else that you can ever get a 40% gain, not in bonds, not in a CD, not through a bank, not through anything. So that's why the stock market can be so lucrative and can be such a great alternate source of income.